Okay children, now we are going to discuss about the 2016 A-level economics paper MCQ questions. 11th question. The supply curve of good X is given by the following equation: Qx equals 6px, where Qx is the quantity supplied and px is the price of the good X. What can be deduced from this equation regarding the price elasticity of supply of good X? Okay, you know the supply equation is the A plus BP, and here Qx is the supply and Px is the price. At that time the B, that means the slope, delta Q divided by delta P, that is the 6. Now you can see the A is equal to 0. That means the price is 0 and that time quantity supply is also 0. Children, remember that when the supply curve A is 0 means supply curve begins from the origin, that means from the 0. At that time, that means the supply curve begins from the origin, any supply curve. At that time the supply elasticity equal to 1. Here that is why price elasticity of supply is equal to 1 in this equation. Then 12th question. The diagram below shows an increase in supply from S2 to S1 after the removal of a specific tax imposed on the good X. Supply curve S1 was the pre-tax supply curve as well as the supply curve after removal of the tax. First of all, we should understand what is the tax and the equilibrium prices and equilibrium quantities. Here this is the S1 supply curve, that means before tax supply. At that time the equilibrium price is 20 because the demand and supply curve intersect each other. The price is 20 and the quantity is 100. Then after tax imposed, the supply curve shift to leftward and the supply at that time equilibrium price is 24 and the quantity is 60. Now we are going to understand about the tax burden. That means the tax burden, government tax revenue. So here the 24 is the price and the quantity is 60. The quantity is 60, the equilibrium quantity, new equilibrium quantity, where the place the before supply curve intersect. Here new equilibrium is, quantity equilibrium is 60. The place the quantity curve cuts the quantity line cuts the before supply curve here intersect here. At that time the price is 16. Okay, then 16 to 24 equilibrium 24, 16 to 24 is the tax. So this is the quantity 60, here the line 60, 24 to 16 is the tax revenue of the government, or this is 20 to 24 is the consumer's tax revenue, consumer's tax burden, and 16 to 20 is the producer's tax burden. Both tax burdens are the government tax revenue. So we are going to understand and discuss about the questions. Okay, what effect does the removal of the tax have on tax revenue and consumer expenditure? What happened to the consumer expenditure and tax revenue? Removal of the tax they mention here. S1 was the pre-tax supply curve as well as the supply curve after removal tax. When tax removed, the S2 is loss. Then S1, so you know this is the tax, and when the tax removal means the tax revenue, the government lost their tax revenue. Here how to calculate the tax revenue? 24 to 16, 16, that is 8, and the quantity 60. At that time the tax revenue is 480. So removal tax means decrease by 480, tax revenue decrease. Then consumer expenditure. Here consumer expenditure. Children, remember that when you go to the market, you need to purchase a good. When we think about it, is the price and the quantity. So you purchase 20 quantities and the price is 10 to 100 your expenditure. Your expenditure equal to producer's revenue, because you purchase something, you give for the supplier that amount, that is his or her revenue, that means income. So producer's revenue equals to consumer's expenditure. The consumer's expenditure, we are going to find out the price you give and also the quantity you going to purchase, that is the 20 to 100, that is the consumer's expenditure. Here consumer's expenditure before tax 20 to 100, 2000. Then after the tax, your equilibrium price is 24 and the quantity is 60, P into Q, that is the 1440, that is the consumer expenditure after tax. The difference is the 560. So they ask consumer expenditure after removal of the tax, after removal of the tax. You know, removal of the tax, you can purchase more goods and services. You know, when tax imposed, your purchasing amount is reducing. And now the removal of the tax means your purchasing amount is increasing and your expenditure increased by 560. Okay. Then 13th question. The substitution effect is the change in quantity demanded that occurs as a result of substitution. Substitution effects, you think about that as example, we can take as substitutes tea and coffee. When the tea price increases, what happened to the coffee quantity? It is increases, because tea price increases means you like to purchase from the less price good. That means coffee you purchase more. So we concern about the relative prices. That means at that time, with other things remain constant, a change in relative price. You concern about the relative price. Okay, then next one, substitute effect. When other factors remain constant, including the price of substitute goods, due to increase or decrease of the price of concerned goods, change of quantity demand of the considering good as a result of increase or decrease in relative price of the good is known as substitute good effect. You concern about the relative prices of the two goods. Then 14th question. The diagram below shows a country's demand curve for an imported consumer good. The government of this country imposes an import duty equal to P1 to P2 per unit of output. Here the P1 price, the price, equilibrium price, at that time the quantity is Q1. Then the government imposes tax, that means P2 price, at that time the quantity is Q2. Children, they ask, which areas of the diagram measure the resulting loss of consumer surplus and the resulting gain in government revenue? When there is a P1 price, remember that equilibrium price P1, the above triangle is the equilibrium, above triangle of the equilibrium price is the consumer surplus. So here ABC is the consumer surplus in the P1 price. Then when they impose the P2 price, you can see the quantity is Q2. At that time the consumer surplus reducing from the BC, because they receive the consumer surplus as, because this is the P2 price and above the triangle of, that is the consumer surplus above the triangle, that is A. But they ask about here loss in consumer surplus, not about the consumer surplus. Consumer surplus in the P2 price A above triangle, but loss when P1 to P2, that is the BC. BC amount is the loss. Then government tax revenue. Government tax revenue, you can see when P2 price, then the quantity is Q2, we cannot take after that, we can take up to here in the P2 price. Now there is a consumer surplus and B, P1 to P2, B is the government tax revenue. And loss this C, because after Q2 we cannot take this, the deadweight loss. That is why the government gain in tax revenue is the B. Okay, this is the deadweight loss, because they cannot take after the Q2. Now the price P2 and P1 to P2 is the government tax revenue. There may be here supply curve S2 and S1 like that. There is no supply curves they draw. Then 15th question. The diagram below shows market demand curve for a product. The diagram. You can see P1 price and the quantity Q3, that time P2 price and the quantity Q2, P3 price, quantity Q1. They ask, assume that the supply is perfectly elastic and the price of this product is initially P1 price. At that time quantity Q3. If the price increases from P1 to P2 due to a tax levied on the product, the excess burden of the tax is. If the price increases from P1 to P2, price increase, now the quantity is Q2, okay? Excess burden of the tax. Excess burden of the tax means deadweight loss. Same. Then now P1 to P2 increase like before diagram. Here now the tax is P1 to P2 EF. Now it is going to the tax revenue, government tax revenue. We cannot take after the Q2, that means this triangle, small triangle is the excess burden of the tax or deadweight loss, BFC. Okay children, now you can understand how to solve these questions well.